Hi, I'm Robert Maltbie with Singular Research. We were the first firm to recommend a short sale of the major financial sector stocks. I highlighted this in my column in Forbes in early November 2007 before a precipitous decline in Merrill Lynch, Bank of America, Citicorp of 70 to 80%. The reason we were free to do this is our unique business model. Our business is derived from subscriptions to institutional investors, not from banking, and not from trading, and not from sponsored research, unlike Moody's and Standard & Poor's, who were paid by the issuers of much of the debt they rated, a flawed business model in our opinion. To recap, the financials in 2007 we felt would have their earnings crushed flat, and the more exposed components, such as Merrill Lynch and Citicorp, could have their book value slashed dramatically as well when all the subprime slime is exposed and marked to the market. If the meltdown spread further to credit default swaps and leverage buyout debt, Uncle Sam may have to step in with a bucket of treasury cash to stem the tide. Here are the mathematics. The S&P financials are approximately 20% of the S&P in November 2007. The market cap is about $3 trillion, and the normalized earnings at that time were about $250 billion. Now, in the last real estate downturn, lasting from '89 to '94, default rates peaked at 12%, and there was very little subprime financing. Most, if not all, of the recent home purchasers bought their homes with little or no equity. Most, if not all, this equity is already gone, and the majority of these mortgages had yet to reset. What happens to default rates when the payment doubles, you're upside down on your mortgage, thousands of new condos and homes are coming on the market, and there's no ability to refinance? Well, there were 14 million homes purchased between 2005 and 2007, and at least half were done with these exotic mortgages at an average loan amount of $200,000. That puts $1.4 trillion in loans at risk. A 20% haircut on the value of this paper, a low conservative estimate, would require write-downs of $280 billion. In late November, we were not even close, 70 to 80 billion. This does not take into the account the derivatives and levers that had been piled on top of this debt. Financials such as Citi, Merrill, and Bank of America may have to mark off-balance sheet debt to the market and absorb these losses back onto their balance sheets. Not an attractive proposition for these companies. Write-downs would wipe out much of their equity, putting them in violation of Fed Tier 1 capital requirements and generating a significant margin call, forcing a fire sale of assets and reducing earnings power even more. Currently, it's estimated that the mea culpa write-downs in late November approached $70 to $80 billion. Clearly, more work needed to be done. Others tainted with the subprime slime by way of close association include the largest rating agencies that may be vulnerable to fraud charges, in addition to a 20 to 40% haircut in earnings growth now that that business has gone away. These agencies, such as Moody's and Standard & Poor's, appeared to have rubber-stamped A ratings on many collateralized debt obligations tainted with subprime mortgages. They base this on hypothetical valuation models, possibly shared too closely with the CDO issuers such as Merrill and Bank of America and others. More likely, even unlikely, assumptions of linear home appreciation forever doomed these valuations. Also, these agencies will face the usual conflict of interest charges because they receive significant compensation from the issuers they rated. A flawed business model in our judgment. This is Robert Maltbie with Singular Research.